Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Economy Show, we have a lot to cover. We'll try to go quickly through some of the key data points, but the overarching theme is that the leading indicators continue to be bifurcated. Some of them are really good. Some of them are pointing to a bit more of a longer term problem. And then the underlying theme across all of this is inflation is coming and it's already here. It's just where is it and who is experiencing it the most. So we're going to break this into the 5 different sections. We're going to have the first one looking a bit global in terms of some of those impacts. Then we're going to go into more of a US focused leading indicator look in terms of what happened, GDP review. Then really in the third segment, dig into inflation. What is the driver? Where are we seeing the impacts? Fourth one, we'll go through Europe, emerging markets. What are some of the structures that we're seeing? And then the last one is really going to go deeper into India, South Korea, but also China, because we're starting to see that strife continue to increase, not only just on a geopolitical level, but also on an economic level. So before we get into it, again, we'd like to remind you, please like, share, subscribe. So the first 2 slides are really carried over from the EIA show. It's just looking at the economic activity in general, just because we like to kind of kick off where are things right now. So you can see Japan continues to slow. France has a little bit of a recovery. Germany has that nice little bounce. It's just France and Germany we think are going to start to flatline at these levels and start to pare back a little bit. But realistically, the UK is one that is going to continue to struggle in general, where when we look at, okay, well, what has the US done? We've seen the US get a little bit better, but there's different data points saying on how much better will the US get. And we're starting to see some of that differences in terms of where is the demand coming from? Is there legs behind it? Or are we going to start to see a bit more of a struggle, which we'll talk about in the second segment? When we look at just other markets, specifically China. So here you can see China is slowing down a bit. We're going to talk about that in way more detail when we start looking at some of their the bigger headwinds, specifically PMIs, the Caxian PMIs, as well as just exports, imports. India is slowing slightly, but again, not too much. And we'll talk about that again in the last segment. And Brazil is one that we want to watch because Brazil is starting to see some inflation. It's starting to see some movements, but India is also doing some interesting things with their balance sheets, which, if you look at their budget, the budget is exploding. So that means they're going to have to go out there and raise capital through the debt financing. So there's going to be a lot to watch as we go through these numbers and start to look at where some of the pressures are. Again, this is looking against virus deaths, but we're not seeing, some of that is starting to slow down, starting to adjust. So that's not something that we think is going to be a bigger problem because though the death side will start to get a bit better. Now, when we start looking at the PMI data points, because these are things that are very important, and just to kick off, the global manufacturing PMI and its components. So you can see here the PMI numbers remain elevated in general, which is a positive because as we've talked about previously, a PMI above 50 means that we're in expansionary territory. So right now for January, we came in at 53.5, but that's down from December, which was at 53.8. So we're still within a margin of error. We're still expanding, which is a positive, but one of the biggest factors of that expansion is the supplier delivery time. And you're seeing that because there's a huge amount of issues in the supply chain still, that is driving some of the PMI numbers higher than they should be. Now, it's still, if you back that out and weighted appropriately, you're still in a slightly expansionary territory. But the one that we're looking at when we look at new orders and output, that remains fairly strong, which is a positive in terms of seeing the PMI staying in an expansionary mode. The bigger issue is when we look at employment, because employment continues to kind of hang around this 50 level where we're not really expanding, we're not contracting anymore. So on a global level, the employment situation isn't really doing all that much, which is, again, the underpinning problem. Now, typically employment is a lagging indicator, so you should see output go up, you should see new orders, and then when you look at your new orders, you're going to say, wow, I have a lot of activity, I need to go hire people. So It's not unlike to see this. It's just, even though we've had this massive move up and now we're starting to see some of the outputs and new orders roll over, we're seeing the employment flatline. So this just means that we don't think the employment numbers are going to get much better, especially as we're starting to see some of those new orders and outputs slow down. So now let's drill in a bit. When we drill in, when we look at manufacturing output, this is what we're talking about, where we've had a nice surge. The U.S. is up, but now we're seeing the Eurozone flatline. We're seeing the U.K. come down. Japan is rolling over. Asia's starting to flatline, and China has seen a big walk back. Now, China is the one that we'll talk about in segment 5 because that is a bigger problem when we start looking at manufacturing output. Because to remind you, we've been saying their recovery has been a supply recovery, not a demand recovery. The supply chain, which, as we talked about with the delivery times, the supply chain was so impacted that you just had China feeding the beast of orders that were already taken, trying to rejuice the system. And then as we saw the supply normalize, still not there, but getting there, or at least normalizing a bit, you're starting to see some of that economic slowdown roll through, which is, we think, a bigger problem as we go forward and as we start to see how much does this global economic recovery really have legs, given the fact that China was a big part of it, and we just think that that is really overshooting. Now, when we look at global exports, this is what we're talking about. So when we look at global PMI new exports in general, we're seeing some of those slowdowns. And what are those slowdowns? So the merchandise volumes, annual percent change, is starting to come up, but again, they're just going to kind of meet each other, and they're merging to come to this level of, essentially a flattish data point. So you need to see global exports going up and new export orders going up to really incentivize some of the additional flow through. So we know the supply chain has issues. We see the prices exploding. So again, that's going to slow down some of these exports because you have inflation internally, your prices going up, prices paid going up. So again, these are things that are weighing on just general activity. And when we think about how this goes from 2017 into 2018, you can see that nice recovery that we had. But here we're just not seeing that movement. So that's why when we look at the export orders starting to turn down, we think that the merchandise volumes annual percent change is also going to start to flatline and stay within this flattish component. And it's really driven based on, obviously, China being such a big part of the export market. So global manufacturing output has flatlined, which is what we were saying was going to happen as we have export new orders slowing. And China goods exports have come down, and now they're still expansionary, but within a margin of error where they're really kind of flattish. And we think that the manufacturing output is going to turn down with it and come closer. As you can see, that the goods exported typically leads some of that manufacturing output, which comes to, again, that supply recovery as the export market catches up. That's when we start to see some of those large impacts into just manufacturing output. Now, you have a seasonal case as well where Lunar New Year is upon us. Now, there people go on vacation. And if you don't go on a vacation, you have a staycation, and just general activity will slow. So there's a certain amount of seasonality involved. But again, these are things that we think is well beyond just a seasonal impact. So then when we look at this on the U.S. consumer price, because obviously, where are we buying a lot of our stuff? Well, the U.S. consumer price index year over year, typically lags by 1 month to the PMI output prices. And again, you're seeing this increase in PMI pricing at the output side on China. That will get passed through to the U.S. consumer. Again, all these things continue to point to U.S. prices going up, inherent inflation that is going to continue to struggle in terms of where things are going in general. And that's why we, just an introductory into, again, why we think inflation is going to be such a problem, even though the Fed continues to say that it's really not a problem. So, or at least they can control it. So now when we look at the vaccine doses, because again, what is activity? How do we get back to normal? Always comes back down to where are the vaccines currently. So vaccine doses ordered or optioned. Here you can see the EU, UK, US, on a per capita basis. So things are well situated. It's just we need that to actually get delivered. And we've seen some supply chain hiccups, commentary that they're going to make up for those hiccups. Again, it's always going to come to how perfectly is the market priced. And based on right now, we're up 18 handles, pushing that 38.40. Again, it's priced to perfection. So when you look at the government funding for vaccine development, you can see that there's obviously the governments were trying to fund, again, trying to move this forward because the vaccine is seen. And if you just consider how much people have been scared by the COVID, the coverage of it, you need a vaccine to give people the ability to, or freedom to feel as though they can go back about their normal lives. So when we look at vaccine run rate versus government targets, this is, I think, an important one to understand. Where do we sit today and where should we be? So when we look at global assumptions, 1/3 population in the diamond total vaccinations. So when we look at where we are and where the target is, the U.S. is fairly on point for where that government target is. But when you look at Canada, things everyone is very different in terms of where things are, in terms of the percentage of the population. And Canada's been fairly slow, but they have started to catch up on getting to their target. They're still off in terms of the pace, but they're starting to close that gap, where Germany and France continue to remain well off of where they need to be. And the idea for herd immunity is 80% of the population. So if you think about trying to get to that 80% mark, the U.S. is trying to hit that essentially on a vaccine level by the end of 2021. But when we look at Germany, that wouldn't be achieved until, based on the percentages right now, the end of 2022. France, about the same thing. Again, so that's why Germany and France are trying to increase their run rate in order to kind of close that gap and to get to where they need to be on that global assumption on the 1/3 population. So again, these are things that we need to consider on how do we normalize. So then when we think on, as I said, the market is priced perfectly. This is the Paaniq versus Euphoria. And clearly everybody is euphoric. The market is booming. Everybody is happy. The world is great. And everybody wants to own stocks. So this is where we sit. We've come off a little bit, but again, there's still well above where we were in the dot-com bubble, in the finance crisis, and it's just in general. Like, there's not much to say in terms of just everybody feels really good about where we sit in the world today. Don't get me wrong, it's partly due to the fact that we've gotten a lot of governments just printing money, pushing money in. The Fed, central banks in general, just continue to print money. And here is where we sit on the projection of about 124% of GDP to debt on advanced economies and about 63% on emerging markets. So when we think about where we were at GDP post World War II, we were at a similar place on government in debt levels. But what were we doing? We were obviously fighting a war, but then we also had a massive rebuild. We had a huge GDP bump that really took us through the end of the 40s into the 50s, and then you continued to see this move and this rejuvenation of economies in general. You had, in the U.S., you had people coming back from war. What did they want? They wanted the American dream. They wanted a suburban life. They wanted a car. They wanted a house. All of those things led to just more stuff being purchased, being made, being created. And what do we have now? Like, we've had no real growth since 08, 09, once you back out inflation, in terms of just real economic growth. So now we have this surge to what? How are we going to pay down this debt? Because there's one of two ways. The debt either starts to dwindle, and then that will bring the percentage down, or GDP has to go up. So if GDP goes up, then inherently you'll have a lower percentage because GDP is getting stronger. Again, these are things that we struggle to see in terms of just inherent growth as we go through the remainder of this year. Now, when we think about, obviously consumers are getting a lot of money from the government, and this is an idea of, well, what would you do with that money? And just given what people are saying and really of any income level, they're talking about saving it. And why are they going to save it? It's because they continue to be concerned about how quickly they can go back to work. And especially on the under 50,000 and even the lower end of 50 to 100,000 income level, prices are going up to just general life. So because of that, they're already pulling from savings. So they would use this money to rejuvenate the savings that they've already pulled down. Again, pulling out some of this hope of this resurgence of just spending that would come from this injection of capital that was expected coming from the government in general. And then, next week we'll talk about the Biden plan, which is about 1.9 trillion. And then you have the Republican plan, which is about 650 billion, and how they were looking to spend the money a little bit differently. Obviously, the Republicans are a bit more on the hawkish side and looking to spend a little bit less and try to just oversize some different parts of that to get the economy going. Excuse me, where the Democratic one is a bit more of a broad stroke and getting some money into multiple different facets of the economy versus the Republican one, which is a bit more targeted. When we'll go through that in more detail next week. But the one thing that we wanted to look at, because the ILO put out a report on home-based workers in 2019. And so it was interesting because we had 260 million people throughout the world. Obviously, these are estimates. It's hard to gauge. But 260 million people working from home, which is about 8% of the global employment. Working from home has jumped 20 to 30% of the labor force, depending on the country. Now, this was in 2019. What does 2021 look like? And this is where we want to look at, how is this pivoting? Is this going to be a much bigger part of the future? And how is that going to change consumption or oil consumption as we were assuming it was going to be over the next, let's call it 3 to 5 years? So when we look at the percentage of workers who are home-based, you can see at this point in the U.S., only 5 to 10% are home-based in 2019. Now, as we continue to see some of this demand going up, it's going to be interesting because when we look at home-based, the data so far is saying that about 30 to 40% of the people want a flexible schedule, and on a corporate level, the numbers match up pretty well. Some people want a more permanent work from home, and that doesn't jive as well with what the employers want. So there will be this flexible basis. And if we think about where we're coming from in 2019, where are we going to be when instead of being in that 5 to 10% range, but maybe that 10 to 15% range? What is that going to do to oil demand? What is that going to do to just the inherent needs for infrastructure, from internet, from servers, just activity in general? And these are things to consider as you're looking at investments, where to invest your money. We're doing the infrastructure fund for a reason. Like, these are things that we want to address as we think more and more people will work from home in general. And then when we think about the worldwide distribution, these are the employees, and again, contributing family workers, own accounts. So low income continues to be on the lower end on the people who are working from home. But when you look at middle income, high income, in general, the view is that the middle income level is going to become a much bigger portion of it, and the high income one is going to shift over a bit, where home base is going to increase just when you're thinking about the distribution. But middle income and high income is one where we think we're going to see some of that expansion on, that home-based components, especially the middle income side, as corporations look to cut spending, and the middle income wants a better quality of life. So if I can work from home, and have a lower cost of living, well, why wouldn't I do that? And those are things that we're going to look at And when we talk about it in a few more minutes. So then when we look at the occupation structure of home-based workers, when we look at India, Mexico, Argentina, Italy, UK, US in general, you can see that obviously more managers work from home. But these professionals, like look at the US at 12% on that side on the professionals. Technicians 27%. We're just thinking that this professional side on the US level is going to move closer to what we're seeing on, not to the same level of Italy, UK, but we're going to see some of that increase in general as we get some of that shift, some of those individuals that are going to try to do more from home in general. And then those home workers are going to become a much bigger portion of the future. And that's when we look at that hourly earnings. Home workers typically earn a bit less, depending on where you are, because in the UK, it's something similar. But you're seeing more hours being worked at home. So are you really getting a benefit, or is it just you're expanding your workday because you're doing more in between? So there's something to consider of, well, if I am going to earn less working from home, I need to be in a place that has a lower cost of living. Again, coming to that middle income component increasing in size as we start to see this shift. And what is the long-term trajectory of oil demand in general, gasoline demand, and then diesel in terms of moving stuff throughout the logistical system. And that's where working from home means working more hours for most people. And this is across the board. This is not just in the US where we're seeing March to April, January is the same, but UK, Spain, all of these countries are seeing an increase in hours being worked from home. Why? Because there's more time. Just to give you an example, and this is just personal. So when I was going to the city and working in the city, that's an hour and a half to 2 hours of travel time. So I was traveling either without service, without using Wi-Fi. I was traveling for an hour and a half to 2 hours. People are now taking that travel time and dedicating it to some of their work from home. They're also a little bit less efficient. There's more distraction. There's more things to do. I can run to the kitchen, see my kids, do something. So there's a mixture of both. And this is what we have to consider on the efficiency of using your time appropriately, which I think is going to become a bigger story going forward of how are we going to see this mesh into the employment situation? And is this going to become an employment strategy when employers are competing for new employees? Are they going to offer a more flexible schedule and some optimization to attract workers, just as we did in the 40s and 50s with pensions and covered healthcare? These are things that we have to consider that will become a much bigger part of the employment package as we start to see that shift on just a structural level on employment in general.